I recently watched a TikTok video where a digital marketer shared why he buys so many expensive vehicles and watches. He claimed to have a Porsche, a couple of Lamborghinis, Mercedes, and Range Rovers. His secret is every month his accountant tells him how much money he needs to spend to pay zero taxes at the end of the year. He said he claims a tax deduction every time he buys a six-figure car or a watch. As a former tax accountant, the tax advice shared in the video made me cringe. So stay tuned. I'll share why this is bad business advice, what's really happening behind the scenes on your tax return, and the effect the decision makes on your cash flow. Before we dive in, I want to address the elephant in the room. Yes, I am all for claiming every tax deduction you and your business are entitled to, but I'm not a fan of spending money for the sole purpose of claiming a tax deduction. You must consider the effect on your cash flow. So let's start with the 5 reasons why zeroing out your profit is bad business advice. First, it drains your cash. The only way to reduce your income taxes is to spend money. When you spend money to save on taxes, you no longer have that money that you need to fund your growth plans or to pay down your debt. When an opportunity or a problem presents itself, you will not have the cash that you need. When you zero out profit and taxes, you are essentially resetting everything in your business to zero. This is why business owners feel stuck on the hamster wheel. Also, it's just bad math. You're spending 100% of your cash to save 30% in taxes. Imagine spending $100,000 for a new luxury car. You are at the 30% tax rate. You save taxes of $30,000 on that purchase, but you're out of cash $70,000. What if you just paid the $30,000 in taxes and kept the $70,000 in your business and take your business to that next level? When you spend money for the sole purpose of saving taxes, it's like walking up to a slot machine, inserting a $100 bill, and celebrating when the machine gives you $30 back. That's just poor financial investment, and then you're compounding that by investing in a car that typically depreciates in value. If you need the cash later on, you're going to need to sell the car for less than what you paid for it. Now, keep in mind, a great financial investment would be investing in vehicles that serve a business purpose, like generating revenue. Claiming tax deductions is all fun and games until you actually need to borrow money or sell your company. Think about it. If your goal is to zero out profit, how will your business show the true profitability and cash flow that is needed to borrow money or show the value of the company when you're ready to sell? It's difficult to normalize your financial statements when you spend money for the purpose of reducing taxes. Loan officers and potential buyers, they're going to lose trust in your financial statements if you're adding all of these line items back. You may be thinking, I can explain that wasn't really a business expense, but this really goes beyond the IRS rules. Your business needs cash to survive and grow. Stop trying to game the system. Be intentional with how you are spending the money. But you might be thinking, wait a minute, Tina, if this is such a bad thing to do to zero out profit, then why is my tax accountant encouraging me to spend the money? I want you to think about your relationship with your tax accountant. What do you talk to your tax accountant about? Of course, taxes. You hired them to prepare your tax return and help you save money on taxes. But have you shared your growth plans with your tax accountant? Have they created a cash flow projection to make sure you'll have the money you need to hire a new employee or start a new revenue stream? This is a classic example of this law in action. If the only tool you have is a hammer, it's tempting to treat everything as if it were a nail. It's natural for your tax accountant to help you save money related to taxes. The problem is there's a disconnect. Their viewpoint is limited if they are not involved in other financial matters. Setting prices, managing cash flow, and learning about your growth plans are really important to help have a balanced financial plan. When your tax accountant advises you to spend money to reduce your taxes, simply ask, how will this affect my overall cash flow? Will I have the money that I'll need to support the business through the slow season? And will I have the money that I need for my growth plans? Invite your tax accountant into the conversation. This will help you make better decisions. When you hear bits and pieces of tax advice, there's usually more to the story. So let's consider the special rules that apply to buying a company vehicle. So in our example, we are buying a $100,000 luxury car. It's considered to be an asset. It's going to be depreciated over a 5-year period and will enjoy a $20,000 tax deduction every year for 5 years. Now, keep in mind that some vehicles qualify for the Section 179 deduction where you can claim 100% in the first year. But there's a lot of limitations when it comes to luxury vehicles. So to keep this example simple, I'm going to just use regular straight depreciation to show what's happening from a tax and cash flow financial viewpoint. So when you're looking at the tax viewpoint with our example, we are enjoying a $20,000 tax deduction. After 5 years, the car will be fully depreciated because 5 years times the $20,000 deduction will equal the $100,000. From a cash flow standpoint, when we purchased the car, we reduced our cash by $100,000. During that first year, we received a tax savings of $6,000. I'm taking my tax deduction of $20,000 times the 30% tax rate. That gives us a $6,000 tax savings for that first year. That means that our overall cash during that first year decreased by $94,000. From years 2 through 5, we'll continue to save $6,000 a year in taxes. And so after the 5-year period, we'll actually have a total tax savings of $30,000. And our net cash after that 5-year period is a decrease of $70,000. Notice how we did not save $100,000 in taxes. We only saved $30,000 over a 5-year period. Instead of spending $100,000 to zero out our profit and our taxes, what if we paid the $30,000 in taxes so that way we could save the difference of $70,000? What could you do with that extra $70,000 of cash in your business? One of my favorite illustrations is in the book Cash Flow Quadrant by Robert Kiyosaki. He states we are all in one of the 4 quadrants. First, we most likely started our career as an employee where we traded our time for money and we had a job. When we decide to start our own business, we're still trading our time for money, but we own the job. And as the business starts to grow, we hire people, we create systems, and we start to get the people to work for us to generate that revenue. And then as we start to generate a surplus of cash, the money starts to work for us. That's where we're able to take money out, invest it in savings, the stock market, maybe in real estate, or in another business. When you zero out profit to zero out taxes, you'll get stuck on the hamster wheel, which will keep you in the self-employed quadrant. One of the ways to shift to a big business mindset is to think about taxes the way big companies do. They consider taxes to be a cost of doing business. It is not a penalty for being successful. They include income taxes in their prices. They reserve money every month so that there are no cash flow surprises. They also list income taxes as an expense on their profit and loss statement, so that way they're seeing true profitability of their business. The bottom line is, before you spend money to reduce your taxes, I want you to consider all 3 financial angles: your growth plans, cash flow, and tax. Ask yourself, will the purchase push the company towards our goal? Will we have something to show for the investment 5 years from now? You are the financial leader of the company, so invest a little time to make sure you are making the right decision for your business long term. Thank you so much for watching. Click on the link to watch the next video, everything you need to know about tax deductions in under 15 minutes.